Hello, doctor. My name is TIAN. The subject of my speech is the impact of fintech on banking. The influence of fintech is beginning to be felt in the banking sector and capital markets. This video talks about its development and its impact on efficiency, banking markets structure, strategies of incumbents and entrants, and financial stability. Fintech has a welfare-enhancing, disruptive capability, but regulation needs to adapt so that the new technology delivers the promised benefit without endangering financial stability. Fintech may be understood as the use of innovation, information, and automation technology in financial services. New digital technologies automate a wide range of financial activities and may provide new and more cost-effective products in parts of the financial sector, ranging from lending to asset management and from portfolio advice to the payment system. In those segments, the impact of fintech competitors is beginning to be felt in the banking sector and capital markets. The fintech business and efficiency. The main development in the application of digital technology have already so far in lending, payment systems, financial advising, and insurance. In all those segments of business, fintech could be a door for unserviced parts of the population and for less developed countries. One of the reasons for this efficiency enhancing role lies in the potential to have overcome information asymmetries, which are at the root of banking business. At the same time, fintech firms have no legacy technologies to deal with and a culture of efficient operational design. This leads them to have a large innovating capacity than traditional entities. Peer-to-peer (P2P) lending platforms provide credits without bank intermediation where individuals and companies invest in small business. Those platforms match borrowers and lenders directly. Some allow the lenders to choose the borrowers. In others, they form package of loans, and online auctions are often used. Their platforms frequently provide risk rankings of the business obtained by algorithms to screen borrowers using big data. Traditional payment systems may also be disrupted by digital currencies such as Bitcoin. It allows value to be transferred peer-to-peer without any intermediary to verify the transaction with a large number of computers authenticating each transaction sequentially. The impact of fintech on banking market structure. Fintech competitors are encroaching on the traditional business of banks, despite the fact that banks are adapting to digital world. New competitors are able to use hard information to erode the traditional relationship between bank and customer, based on the knowledge gained from bank and customer relationships. However, most new competitors stay clear of asking for a banking license in order to avoid compliance costs and try to scheme profitable business from banks. Banking have traditionally focused on products, while new tracks are more focused on customs. Fintech competitors are putting pressure on the traditional business model of banks to competitive advantages of retail banks, which may be eroded by the new entrant, or that number one, banks can borrow cheaply with their access to cheap deposit and explicit or implicit insurance by the government. And number two, they enjoy privileged access to stable customer base that can be sold around products. The strategies of the players, information technology and electronic banking, and the emergence of fintech competitors make retail banking more contestable. First, the lighter regulation of fintech providers will have an important bearing on the competition between banks and the new entrants such as payment systems providers or crowded funding platforms. Second, electronic banking is subject to exogenous and endogenous fluctuation, switching costs, regulation and financial stability. Digital technologies can also be applied to solve regulatory and compliance requirements more effectively. This is known as RegTech. The challenge for regulation is how to keep a level playing field between incumbents and new entrants so that innovation is promoted and financial stability is preserved. New fintech entrants should not become the new shadow banking outside the regulatory perimeter that contributed so decisively to the 2007 to 2009 financial crisis by hiding systemic risk under the rug. The outcome is that to maintain a level playing field between incumbents and entrants will not be easy since a light regulation of fintech to encourage entry. To balance the built-in funding and too big to fail advantages of incumbents should account for the risk of developing a new shadow banking system that increases systemic risk. In summary, fintech has a large and potentially welfare-enhancing distributive capability. However, in order to the new technology to deliver the benefits for customers and firms without endangering financial stability, regulation needs to rise to the challenge. Thanks for listening. Goodbye.